Hey, Dan Passarelli here. How you feeling today? Oh my goodness, we've got amazing things to talk about today. Advanced options investing and how to maximize returns with the covered strangle. Now, this is going to be a really, really good one. I'm glad you showed up. Now, before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading and get a copy of that by emailing investor services at theocc.com. Only trade with money you are prepared to lose. Don't trade with money you're not prepared to lose. And one more thing, this is all generalized information. It is not specific advice specific to your needs. Now, if this is your first exposure to one of the Firstrade webinars that I present every Tuesday, well, first of all, holy cow, you're missing out on a lot. You should have been here last week and the week before and the week before that. But better late than never. Allow me to introduce myself. I am Dan Passarelli, and I've been doing this a long time. I am an author of two of the most popular option trading books. I am a trader. I started trading, goodness gracious, started trading in college, and that was a long darn time ago. But I was a market maker on the floor of the Chicago Board Options Exchange, Chicago Board of Trade, CME Group. And now I trade in a retail trading account just like you. And about 17 years ago now, I founded Market Taker Mentoring, which is the leader in option trader education. And I work with a lot of great options related companies in the industry, options friendly brokers like Firstrade, many of the exchanges in the world as well. And I'm a family man. Those of you who are currently Market Taker students or who are on our Substack, you're probably familiar with Kathleen, my wife, who also runs operations here with Market Taker, and have two adult children. And we love to do fun things together. Kathleen and I ran some marathons together. Whole family we're all food nerds, travel nerds, been all over the world together. We're a musical family. And, I think it's important to share these things because one of the things that helps me be able to do all the things that I love to do is options trading, the whole world of options trading. And I hope that that's inspiring to you. Now, I briefly mentioned this a minute ago, but if you're ready to make 2025 your year to kick it off with wealth building success using options, you should join my new Wealth Building with Options Substack. That is your ultimate hub for daily wealth building strategies. And you get access to a whole bunch of really, really great things. There's a free subscription and there's a very, very inexpensive but high valued paid subscription as well, where you get trade alerts from John Kamisik, our head coach. My wheel trade trades, which is kind of similar to what we're talking about here today. I don't think I've posted on a covered strangle just yet, but I'm sure I will at some point. And early access to the Wealth Building with Options podcast, which is coming out imminently. And you can get all of this by going to wealthbuildingwithoptions.substack.com. wealthbuildingwithoptions.substack.com. All right, now let's get into the heart of the matter here, the covered strangle. So a covered strangle combines a covered call and selling puts. And we've talked about both of these things here in Firstrade webinars. We've talked about covered calls at least once. We've talked about selling puts at least once. And this does both of those things. And it's a pretty magical strategy under the right circumstances. It can potentially very, very strongly outperform just the simple buy and hold investing strategy. So, what is this magical thing we talk about today? The covered strangle? Well, this is what it is. It's when I own shares of stock or an ETF, and I sell an out of the money call, which combined with the stock would be a covered call. But then I also sell an out of the money put. Now, I am a big fan of looking at things from many different perspectives when I'm trying to deeply understand them. Like, if you're in the market for a new car, right? Maybe you want to save some dough, get a used car. We've had a car that's been paid off for a while, and I'm not going to mention any names, but there's somebody in our family. It's not me, it's not Kathleen, somebody else in our family who crashed the car, and I'm hoping it's not totaled because the darn thing was paid off already. I don't want another car payment. So we might end up getting a used car if it's totaled, which I don't really want to do, but we might. We'll consider that. If I'm going to look for a used car, I'm going to look at the car from the driver's side. I'm going to look at it from the passenger side. I'm going to look at it from the front and from the back. I'm going to get inside it. I'm going to look at everything I can see from sitting in that driver's seat. I'll probably take a peek in the back seat, make sure that there's nothing out of place. I like to look at it on all these different angles so that I can really get a full whole picture of it, right? Well, I do the same thing when it comes to option strategies. So a great way to look at this is it's a covered call with an out of the money put. But we call it the covered strangle because let's look at it a different way. What it really is a strangle with long stock. So what is a strangle? A strangle is when I sell a call, usually out of the money, so a higher strike call, and a put, usually out of the money, so a lower strike put, in the same expiration on the same stock. Now, that's selling a strangle. We could also buy a strangle. That's not what we're talking about here today. I'm talking about selling a strangle, selling that out of the money put, out of the money call, and having long stock. So that's a different way to look at it, and that's going to come in handy as soon as we talk about the risk reward of this thing. Now, this is considered to be a conservative investor strategy, but it's actually kind of an aggressive conservative investor strategy, if that makes any sense at all. And I say that because a covered call is proven to be lower risk with statistically greater profit. A cash secured put is statistically proven to be lower risk, lower standard deviation with statistically higher returns. So we've got two different strategies that we're doing at the same time that both lower your risk and increase returns. But we're doing them both. So it's kind of like a conservative investor strategy, but kind of on steroids or whatever, right? It's used only in a very specific situation. That's why on wealthbuildingwithoptions.substack.com, where I post all my covered call trades, all my cash secured put trades, all my stock or pair trades, which we've done a webinar on that too. Go back to the archives. I still haven't yet posted a covered strangle trade. I've only been posting these trade logs for about a month. And that's because it's used in a very specific situation. Actually, come to think about it, I did have one of these on within the past month. Did I do a write-up on this? Yeah, I had one on in Arch, A-R-C-H. I don't have it on now. I was trying to work one, but I only got filled on one leg of it. More on that in a minute. So the specific situation is the investor, which would be you hypothetically in this example, would consider buying more shares of this stock at a lower price. I think that the stock will go up a little bit, but not a ton. There's probably an upper limit for it. And in fact, if it goes up too much, I would like to sell it. let me ask a question. This is going to be the interactive portion of our event today. Let me ask a question. Have you ever been in a situation where a stock you own as a long-term investment has been trading in a range for a long time, 4, 6, 12 months, and you just watch it and you think, hey, you know what? If it gets down here, it always bounces off that support it has for the last year. If it gets up to here, it tends to pull back off that resistance. Have you ever owned a stock like that? Give me a yes or a no. Have you ever owned a stock in your investment account? Hit that questions box. Have you ever owned a stock in your investment account where it's been in just sort of a broad range? Like Arch, for example, has bounced around between like 135 and 165 for a long time. Every time it gets up too high, I sell a covered call. When it gets down too low, I sell a cash secured put. And sometimes when it goes up and down, I leg into it and I do both. Yeah, so Oslam says yes. Excellent. I like that. The Diesel says yes, that's a good time to use. Well, this is a different strategy here, Diesel, for a different purpose. The Diesel said, yes, that's a good time to use an iron condor when a stock is range bound. But that is a trading strategy. What I'm talking about specifically today, the Diesel, is I'm talking about investing strategies, which is fundamentally different. And it's extremely important to understand the difference. So, but good. And I see you've got a couple other questions here. I tend to hold all questions till the end. So these are good questions. Actually, the first one I'll probably answer in just a second because that's relevant to what I'm about to talk about. Okay, so here is how this looks. Now there's kind of a whole bunch going on here. Look at this. We've got 3 components of this position. Long stock from $80 a share. So at some point, or like right now, the stock I bought it right now at $80 a share, or I bought it 10 years ago at some price, but right now it's at $80 a share. And I noticed that there's resistance up above 85. And it's very strong resistance. It just keeps bouncing. Every time it gets up there, it comes down. So I'm going to sell the 85 calls at $2. And I also noticed that there's really strong support at 75. For the past year, every time it's gotten down around 75, it's bounced back higher. And because of that, I would like to buy more if it gets down to 75 in this hypothetical example on this hypothetical stock. But there are definitely stocks like this out there. So I'm going to sell a cash secured put, which means I sell the put, but I hold cash in the account so that if the stock goes under 75 and I get assigned, I have cash to buy the stock with if I get assigned. So the Diesel asked earlier, how would you set up the strategy if you do not want to own the underlying stock, however, want to take advantage of the upward momentum of the stock? Well, the covered strangle is owning the stock and potentially owning even more if it goes down more. This is like value investing using technical analysis, of course. It's, just average dollar price investing. So this is an investing strategy in which you own the stock. Now, is it possible to set this up in a different way where you don't own the stock to be more of a trade or a less committed investment? Yeah. You could use a leaps, deep in the money leaps call or something like that, or just a deep in the money, somewhat longer term call. But to me, that's a little bit of a different strategy. That's a less committed investment, or it's a trade. And the diesel, I'm going to save your other question for later. So let's take a look at this now. There's a lot of nuance to this. In a lot of ways, this is super simple. It's all strategies you already know. Long stock. Okay. Yeah, I mean, that's easy. Like children understand that one. It's covered call. The stock goes above 85 and is above 85 at expiration. What happens to that short 85 strike call? Who can tell me? Interactive time again. If the stock goes up above 85 and is trading above 85 at expiration, what happens first to the 85 call? Contest. I got to talk to our production department. Can you please cue the Jeopardy theme song? No, nobody. You don't even have to phrase it in the form of a question. There you go. Aslam. I can always count on Aslam week after week, every week. You're there. You're there for me. I love it. Okay, so that's right. You give up the stock. Your stock gets called away. That's why they call it a call. So you get assigned, and the 100 shares of stock that you own at 80 get sold at $85 a share. But there's a little bit of magic. Oh, so that being said, you have no more position. Wait a minute. No more position. What about the 75 puts? If the stock is above 85 at expiration, what happens to those 75 puts? Who can tell me that? I know Aslam can. Anybody else? Or is our star pupil going to do all the heavy lifting for us? Anybody else? Who else is in here? That's right. You keep the premium and that put expires. Nice work, my friend. The put expires and you keep that premium. So wait, actually, you sell the stock you owned from $80. You sell at $85, but you keep the put premium of 3, and you also keep the call premium of 3. So effectively, what you bought at 80, you're technically selling at 85, but you get to keep an extra $2 and an extra $3. You're effectively selling it at $90 a share. That's pretty amazing right there, isn't it? Okay. What if the stock is between 75 and 85 at expiration? What happens to the, okay, so A, and in your answers, don't everybody all rush now, but in your answers, A, what happens to the 85 call, and then type B and tell me what happens to the 75 put. If the stock is between 75 and 85 at expiration, what happens to the 85 call? What happens to the 75 put? Who can tell me? Somebody can tell me. Both expire. Boom, boom, boom. Nice work. Nice work, my friend. They both expire, which means I own the stock at 80, but now that these calls expired, I also have an extra $5 in my pocket. Well, technically it's in my account. So it's kind of like owning the stock at 75, isn't it? That's my effective price. Now, it's not for tax reasons or anything like that. Talk to your accountant about all that stuff. But that's the way I think about it. Okay. Which basically means if I do this just this one time and the stock falls down to 75, I didn't lose any money. Lost money on the stock, but I get to keep all that option premium. If I do this many times over, it becomes really powerful. Okay, next question. If the stock is below 75 at expiration, what happens to the 75 puts? What happens to the 75 puts? Boom. Oh, Aslam, you're too slow now, baby. Yeah. Uh, Don Liam, I hope I said that correct. Now you can correct me if you want, or just accept my apology for mispronouncing it. Uh, Don Liam says, you buy the stock. That's right, man. You get assigned on the stock. No, you get assigned on the put and you buy the stock at 75 bucks. Now you already own the stock. That's right. You're buying another 100 shares because every one put represents the rights on 100 shares. So now I own 200 shares. So see how this works? This is actually kind of interesting if you think about it, right? Um, Stock goes higher, you have no position. Stock stays where it is, you keep the same position. Stock goes down, you accumulate your position. Imagine if you did this over and over and over again. What are you always doing? You're always buying low when it goes down, selling high when it goes up, and in this really broad range in the middle, you're just staying status quo, but taking in premiums after premiums, double premiums. Okay, so that's what happens to the 75 puts. What happens to the 85 calls? That's an easy one. The 85 calls just expire. So that means I keep $2, I keep $3, bought another 200 shares. Well, no, bought another 100 shares at 75. But since I'm keeping an extra $5, it's kind of like buying the stock at $70 a share, the extra stock. It's pretty darn amazing, right? Okay, let's look at a more realistic example here. So this is a stock. I just took the screenshot yesterday. Doesn't matter what stock is. You'd probably be able to figure out on the next page, but you know, I like to just kind of keep it neutral because I'm not giving trade ideas per se, but I want you to understand this deeply enough so that when you see something like this, you recognize it and you can act on it. Okay, so this stock, we bought this stock on a dip. You know, maybe we bought it like here, right? Or maybe even back here. Who knows? And if it goes lower, I would buy more. I want to outperform the market. I'm willing to put in the effort to do what it takes, invest my time in myself because I want more out of my investments and I deserve more out of my investments. So I'm going to put in the time. I'd be pretty surprised if the stock rallies super strongly. And if it did, I'd probably sell it because, you know, I'm getting these lower highs, lower lows, kind of in a downtrend. There was some news that came out on this one about 2 weeks ago, actually, where there's going to be greater competition facing it. So if it goes down, I'd buy more. If it goes up, I'd sell it. If it stays the same, I'm fine. It pays a little bit of a dividend, I think. So here's a real world example here. Own the stock. Right now it's at 228.41 in this hypothetical example. And I'm going to sell a strangle. So I'm going to sell the January 17th in this example, 220 put at $1.87. And well, I actually took this screenshot when the market was closed after hours. So the markets are a little wider than they typically are. But in reality, I could probably sell this for more than $1.87. Excuse me. I'll grab a drink of water here. I could probably sell this for more than $1.87, but you know, whatever, it doesn't matter. We'll just say $1.87 for argument. And so the 237 and a half calls at $1.79. So, you know, let's go back here for a second. Wait, what are these strikes? 220 and 237 and a half. So if it gets down to 220, kind of like where this gap is, I would just buy more. There's a little bit of support there. Arguably, this gap is meant to be filled. Maybe I'd be better off buying the 215 or 210 or selling the 215 or 210 puts, but would I get enough premium if I did? Maybe, you know, 217 and a half puts are still pretty meaty. Selling the 237.5 calls kind of up here. I'd be fine with that. It's a short period of time. It's less than 2 weeks until expiration. And so, if it was more time until expiration, I'd probably sell wider strikes. Could I have sold a higher strike? Yeah, I probably could have. I would have got a decent amount here. But, that's all kind of for you to fine tune and play with. So anyway, I collected a total of $3.66. All right, let's go back at this. What does this look like? Well, it looks like this, right? It's kind of like a little bow and arrow, isn't it? Okay, so let's start in the middle ground here. If this stock stays between 220 and 237.5, which is a fairly big range, that's what, 17.5 bucks on a $228 stock. What does that come out to? About 17% or something like that? Something like that? No, about 8%, something like that. Yeah, about 8%. So as long as it stays in an 8% range over the next week and a half or so, I just get to keep $3.66. A lot of times, that's my goal too. I'm totally happy if I just keep the premium and do it again. Because, and now I'm going to answer the Diesel's question from earlier. The Diesel asked, what is the hedge trade on the covered strangle if this plan goes south? It's to do this a lot. That's what the hedge trade is. I'm already hedged. I can lose $8.41 before it gets to 220. Plus, I have $3.66. It can fall a lot. It can fall, let's see, $8.41 plus 366 is what? I take out my calculator that I probably got when I was in junior high in 1984. So that's 8.41 plus 3.66. It can fall $12.07 divided by 228.41. That's 5.3%. Now, 5.3% in a week and a half, that's still within the range of possibilities. But let's say it doesn't do that this week. It doesn't fall this week, but, or this time around. And then we do this again, sell another 2-week one for another $3.50 or $4 or whatever. Okay, now it can fall 10%. And this whole net, or I guess I should say gross trade of all the trades that I've made over this 2-trade cycle, now it can fall 10%. Now let's say I do it for another 2-week cycle. Now it can fall 15%. It is a natural hedge in and of itself. If you do this trade just once, who cares? You're wasting your time. Covered calls and cash secured puts, covered strangles, the wheel strategy, all these things that are investor options trading strategies, they work when they're done over and over and over again in cycles. That's the whole point of Wealth Building with Options, Substack, and upcoming podcast, an upcoming book for that matter. It's just a natural hedge if you do it over and over again. If you do it once, whoop-de-doo. All right. So thanks for asking that. So I had the opportunity to clarify that. Osm says, how are you deciding the strikes based on support resistance or deltas? Never deltas. Never, ever, ever deltas. Deltas is arbitrary. The options pricing model guarantees no one delta is better to sell than another. That being said, I do it based on support and resistance when I can. In this kind of hypothetical example, there's not really great support and resistance. If I can use support and resistance, I will. The one stock that I mentioned, ARCH, which is like a metallurgical coal company. They do some other coal stuff too. Oops, sorry. Um, you know, they fit that paradigm perfectly. They get down to like 135, they get up to like 165, support, resistance, bouncy, bouncy, bouncy. They only have 1 month options. And so it kind of forces me to go out a month in time where it's really easy to sell some meaty enough options at that support and resistance level. So yeah, great question, Azam, as usual. Okay, so next, same idea here. It goes down, we're buying more at 220, really effectively 217.34, right? If it goes up, we're selling at 237 and a half, really 241.16 when we add in the 366. If we do this over and over and over again, we're always buying lower, selling higher, buying lower, selling higher, taking in 5% of the price of the stock every couple weeks. Wow. Like, are you listening closely to the words I'm saying? Like, this has the potential to be very, very powerful. Now, let's talk about that for a second. Okay, if it is so powerful and you're always buying lower and selling higher and taking in a big percentage of the stock price every time you do this, wow, shouldn't you just do this all the time on every single stock? Well, no, I'm not saying that. Because there are things that can go wrong. What's one thing that can go wrong? Well, this kind of relates to the diesel's question earlier. What if the market crashes or a news article comes out that says something bad is happening in this company, blah, 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 hypothetical, it's not whatever. But if something really bad happens, the stock goes down to 150, well, you can lose. You're going to lose on the stock. And you're going to lose on the additional stock you bought at 220. And if you put this trade on once and that happens the one single time you put this on, well, that is how the ball bounces and that kind of stinks, but bad luck happens. If you do this like 10 times and you've collected $40, in option premium, I mean, the stock can fall to 180 before you actually lose on the whole, big long-term cycle of making this trade. Also, if something fantastic happens in this stock, news article comes out, they're curing cancer or whatever, I don't know, hypothetical, and it goes up to 275, well, you probably left a little bit of money on the table. You probably left a lot of money on the table. And if this is the first time you did this and you only collected $3.66 and it busts up to 275, well, you kind of feel silly. Ah, geez, I should have been able to see the future and shouldn't have sold that call, right? Well, you can't see the future and you still had a winning trade. But if this is the 10th time you've done this and you've collected $40 in option premium, well, you maybe actually still have a profitable position. Didn't leave. Well, you always have a profitable position if it goes up, but you might not have left any money on the table. So let's talk about the real performance of this. Okay, here's our trade. Long stock from 228.41. Short the Jan 17 220 put at $1.87. Short the Jan 17 235 and a half call at $1.79. That's a $3.66 credit. If the stock is between the strikes at expiration, stock performs by, it's 1.6%. Yeah, by 1.6%. Is that right? 1.6%? I guess it is. 1.6%. Still, you do this over and over and over again. Yeah, I mean, if I could make an extra 1.6% every 2 weeks, I'm doing that every time, right? Not that you will. Sometimes you leave money on the table. Sometimes stock goes down and you lose, but still. Upside's potentially given up above 241.16, which is a big, big move. There's that 5% figure. If the stock falls below 220, you buy more for 216.34, making the average price 228.38. So it's good. As I'm asked about this, let's talk more about it. Strike selection. Where do you set the put strike? Where I want to buy more stock. That's why I don't use Delta, because the Delta doesn't tell me where I want to buy more stock. The stock chart does. Support does. If it tends to always bounce up when it hits support, I want to buy more when it's around support because I anticipate it bouncing up and I anticipate making money on that. So think of it as a limit order to buy more stock. Like I want to get assigned. If I don't, that's fine too. I just keep the premium. Where do I set the call strike? Again, not based on Delta. Delta doesn't tell me where I want to sell the stock, but the stock chart does. Resistance. If every time it gets up to resistance, it comes back down, then that's where I want to set my call strike. Think of it as a limit order to sell your stock. Okay. So this is active investing. Again, not trading. We're making more trades on our investments. So it's active investing. We're doing more than the typical buy and hold and, look at your account 10 years later. That's been proven to work in the long run too, but this is proven to work better in the long run. Okay, so this is the close cousin, and I'm going to give you this as a bonus trade today. So I hope you're taking notes, and I hope you're glad you showed up for this to get this bonus trade. This is called the covered straddle, which is similar to the covered strangle and can potentially outperform long stock. And it goes like this. The covered straddle is where I own stock and I sell an at the money straddle. I sell an at the money call and I sell an at the money put. The call is a covered call because I own the stock. The put is cash secured because I keep cash in the account in case I get assigned on the put. Now this one, I'm going to get assigned on one of these. With the covered strangle, I might not get assigned on either of them. In fact, I probably won't. With the covered straddle, because it's a shared strike, it's one value, the stock will be above it or below it. Could it theoretically be exactly right at it at expiration? Sure, but that doesn't happen all that often. Okay, so one of the reasons why I would do the covered straddle is this. At the money options have the highest time premium. If I go in out of the money call, I take in less premium than an at the money call. If I go in out of the money put, I take in less premium than an at the money put. So I'm taking in a lot more premium. So that also means these closer strikes means I buy more or sell more stock with a smaller move in the underlying. I'm always getting assigned on one. And so that looks like this. Okay. We go back to our just sort of generic example here. Long stock from 80 bucks. So I'm going to sell short one September 80 call at 4. Sell short one September 80 put at 5. So there's no V in between the strikes because it's one strike. If I'm above the strike at expiration, the call gets assigned and the 100 shares of stock that I own gets sold and my position's gone. What price do I sell it at? Well, I get assigned on the 80 call, so I sell it at 80. But I'm taking in $5 a premium, so it's really at 85. If the stock is below the strike at expiration, then I get assigned on my put. I buy more, another 100 shares, so I'm long 200 shares. at 80, but I have an extra $5 here, so I'm really buying it more like at 75. Let's use some more real numbers here. Those are just hypothetical. These are kind of hypothetical too, but this is an actual screenshot that I actually took yesterday. Same example, we're long this stock from 228.41. I'm going to sell the 230 put at 5 and the 230 call at 435. 5 plus 435 is 935. Now, in the other example, I was only collecting 366. I'm collecting almost 3 times more, about 260 something percent more. But I'm either going to buy more stock or sell more stock at expiration. And notice when I say at the money, there's no $228.41 strike. There's a 230 strike and a 227.5 strike. I've got to pick one of those. I could have really picked either. I decided to opt for the 230 strike. So what are the implications here? Well, there's a couple of things here. Let's move ahead here. First of all, if held until expiration, I'll definitely get assigned. This generates, instead of 1.6%, this generates 4.1% this month. I mean, really, this 2-week period, in addition to these assignments and exercise situations, implications. I would use this when? Well, if I don't think the stock will rise or fall more than 4.1% in a month, this makes a whole lot of, or not in a month, between now and expiration. So in this case, 2 weeks, this trade makes a ton of sense. And for a lot of stocks, they don't move 4.1% in 2 weeks. Sometimes they do. Sometimes they don't. Stock prices tend to be log normally distributed with fat tails, leptokurtosis, for the people who love fancy words. But overall, smaller moves are more common than big moves. So betting that a stock won't move more than 4.1% in a month, well, that's a pretty good bet. So which of these is better? Straddle or the strangle? You know what I like to do? Remember that analogy of looking at the car from all the different angles? I also like to look at different cars. I like this Jeep Grand Cherokee. It's really nice. Got all the things I like. I like the color, midnight blue. But geez, this Honda Pilot looks really nice too. This one has these features. This one has these features. What am I going to use it for? Well, I got some road trips planned this summer. I got to drive my kid across the country. In this case, this one makes more sense, right? I do that same thing with option positions. If I'm thinking about doing the covered strangle, I'll look at it and I'll look at different strike variations, different expiration variations, but I might also look at the covered straddle. Which one tends to make more sense? Which one can move more? Do I want it to move more? Or would I rather take in a bigger premium because I think it's going to move very little? Do them both, see which one tends to make more sense. Okay, next. The premiums generated. This is where the rubber really hits the road. I mean, honestly, with the strangle, it can move a lot more before getting assigned and buying more stock, like a lot more. And the break evens are a lot wider too. But you only take in 1.6%. If it moves just a little bit, you're way better off with the covered straddle than you are with the covered strangle. But the covered straddle is never a one-time trade, because if you like owning that stock, and it goes up and you sell it, well, now you've got to sell some cash secured puts to try and buy it back and probably sell them at the money. If it goes down, you buy more stock. Well, okay, I'm long more stock, which, I'm hoping that it goes up and so that I can sell it so I can scalp the stock while taking in extra premium. So now you're doing like 2 covered calls on the extra stock. So the covered straddle will always definitely require more trading. Covered strangle really does too, because like I said, these all work so much better as a cycle as opposed to just do it once and whoopee, I made $360. Uh, the covered strangle, I might buy or sell the stock, but the goal is not necessarily always to, maybe to generate income. The covered straddle, I will definitely buy or sell stock. And I'm willing to accept that arguably additional risk to get the much higher option premium taken in. All right, I'm going to open this up to questions. What other questions do you have that I didn't already answer? Because you guys already asked some really, really good ones. Oslam and Diesel and the Diesel. You guys already asked some pretty good questions. Any other questions that you have that I can answer? Before we call it a day. Negative? All right, folks. Well, you know where to find me, either at markettaker.com or at Substack. Oslam, you're welcome. Substack, wealth building with options.substack.com. All right. Have a great rest of your day. This is Dan Passarelli, Trade Smart, and I will see you next time. Bye.